You already own Nvidia. You might not know it, but you do. If you have a 401k, an IRA, or any vanilla S&P 500 index fund, you are holding a position in Nvidia, Microsoft, Apple, Alphabet, Amazon, Meta, and Broadcom, whether you chose to or not. And as of right now, those 8 companies represent roughly 45% of the entire S&P 500's market capitalization, nearly half the index, in a fund that technically holds 500 stocks. That number has a name. Analysts at RBC Wealth Management called it the Great Narrowing. Apollo's chief economist called it the most extreme concentration in modern index history. And the thing nobody in financial media wants to say plainly, because it complicates the just buy and hold narrative they've built entire careers on, is that this isn't a stock market anymore. It's an AI infrastructure bet wearing a 500 stock costume. And if you think understanding the difference between those two things matters, hit subscribe, because that's exactly what this channel is for. Now, back to the costume. The S&P 500 is market cap weighted. That sounds like a boring technical detail, but it's actually the most important sentence in this entire video. So sit with it for a second. Market cap weighted means the bigger a company gets, the more of your index fund dollar goes to that company automatically. You don't vote, you don't choose. The structure does it for you. When Nvidia's market cap grows, Nvidia's slice of the index grows, which means every new dollar flowing into S&P 500 index funds allocates more money to Nvidia, which pushes Nvidia's market cap higher, which grows its slice of the index further. This is not a conspiracy. It's just math. But it's math that only works in one direction until it doesn't. Let's go back to 2015 to see how fast this moved. At the end of that year, the 10 largest companies in the S&P 500 accounted for about 19% of the index's total weight. That was relatively stable. It had hovered in the 18 to 23% range for over 2 decades. Then something broke. By the end of 2025, those same 10 companies, now dominated by AI names, controlled 41% of the index. That top 10 share more than doubled in a single decade, and the acceleration started with one event, the public release of ChatGPT in November 2022. From that moment, the market rewrote its story. Every major tech company was now an AI company. Nvidia went from a gaming chip supplier that most people couldn't pick out of a lineup to the gravitational center of a global infrastructure build-out. Its stock rose roughly 800% in 2 years. Its index weight climbed from around 1% in late 2022 to more than 7% by early 2026, making it, by weight, larger than the entire energy sector of the United States. One company, larger than oil, gas, pipelines, refiners, and every utility that powers your city combined. Meanwhile, passive investing was doing something structurally important and almost entirely unnoticed. According to ICI data from March 2026, passive funds now hold over 54% of U.S. equity assets under management. That's a majority of the money in the American stock market operating on autopilot, allocated by market cap, not by judgment, not by valuation, not by whether a company is actually earning the money its stock price implies it should be earning. Every paycheck that goes into a 401k, every retirement account auto-invested into a target date fund, every college savings plan parked in an S&P 500 ETF. All of it flows upward automatically into the biggest names, into the names that are already biggest, into Nvidia and Microsoft and Apple, reinforcing their size, reinforcing their index weight, reinforcing the number that tomorrow's passive dollar will use to decide how much of itself to give them. Researchers at the Journal of Finance studied this exact dynamic. Hao Jiang, Dmitry Vayanos, and Lu Zheng published findings in March 2025 showing that passive inflows into the S&P 500 increase both returns and volatility among the index's largest firms. And critically, that passive investing makes U.S. equity markets measurably less elastic. Less elastic means a market that responds less efficiently to new information. Prices stick going up and then break suddenly going down, rather than adjusting gradually in both directions. You are building pressure in a system that stopped bleeding off that pressure the way it used to. Here's what that pressure looks like in practice. Strip the AI names out of the S&P 500's returns between May 2024 and June 2026, and the index gained 16%. Keep them in, and it gained 142%. The same index, one number with AI, a completely different number without it. According to JP Morgan's research, just 41 AI-related stocks About 8% of the index's constituents account for 47% of the S&P 500's total market capitalization, a record. The other 459 stocks share the remaining 53. Those 459 stocks contributed just 26% of the index's total gains since ChatGPT launched. The AI 8 contributed the other 74. You are watching a 500-piece orchestra where 8 musicians are playing and the other 492 are holding their instruments in silence. Now, here is where the mechanism gets interesting, because what's holding this structure up is not just investor enthusiasm. It's a spending loop. Microsoft, Alphabet, Amazon, and Meta announced a combined $440 billion in capital expenditures over the next year. Most of it AI infrastructure, data centers, chips, cooling systems, fiber, power. And the vast majority of those chips flow to exactly one company, Nvidia. So the same companies whose stocks drive the index are also the primary customers of the index's largest single holding. Every dollar Microsoft spends building an AI data center is revenue for Nvidia. Every dollar of Nvidia revenue justifies a higher price target. Every higher price target increases Nvidia's market cap. Every increase in market cap increases its index weight. Every increase in index weight means tomorrow's passive dollar allocates more to Nvidia automatically. This is a closed loop. The question is, what happens when someone opens a door? Morgan Stanley published an estimate that makes the risk concrete. A 15% reduction in hyperscaler AI capital expenditure, not a collapse, not a panic, just a modest budget trim from Microsoft or Amazon, would compress Nvidia's forward earnings by roughly 22%. That's a trim, not a shutdown, producing a 22% earnings revision. At Nvidia's current valuation multiples, a 22% earnings compression does not produce a 22% stock decline. It produces something much larger, because the price is not built on what Nvidia earns today. It's built on what the market believes Nvidia will earn in 2027 and 2028 and 2029. Change the trajectory and you don't just shrink the number, you collapse the model. Bank of America's Global Fund Manager Survey from April 2026 noted something telling. Long Magnificent 7 has been the most crowded trade on Wall Street for 23 consecutive months, and 54% of surveyed fund managers now call AI stocks a bubble, up from 38% in late 2025. This is not a fringe concern anymore. It's the consensus opinion of professional investors who are simultaneously still holding the position, because the alternative, underperforming the index while your competitors ride it, is a career-ending move. This is the same dynamic that drove fund managers into dot-com names in 1999 and mortgage-backed securities in 2006. The professional incentive structure of asset management does not reward being right early. It rewards not being obviously wrong at the same time as everyone else. The dot-com parallel keeps coming up, and it's worth being precise about where it holds and where it breaks. In March 2000, the 7 largest names in the S&P 500 accounted for just under 19% of the index. The AI 8 today account for roughly 28%. So the concentration is already 50% more extreme than the dot-com peak. The top 10 stocks as a whole controlled 41% of the index by end of 2025, according to RBC Wealth Management. That's a level not seen since the 1960s. What's different today from 2000 is that these are genuinely profitable companies. Microsoft, Apple, Alphabet, and Amazon generate hundreds of billions in free cash flow annually. Nvidia's data center revenue is real. This is not Webvan. This is not pets.com. The technology works, but none of that tells you whether the price is right. And the price of a stock is not what the company is worth. It's what the next buyer will pay. And the next buyer, increasingly, is an algorithm connected to a payroll system that has never read a balance sheet. If this is the kind of breakdown you want more of, the actual mechanics underneath the headlines, explained without the noise, the Sketchbook Finance newsletter goes deeper every week on exactly this. Stories like this one, but with more detail than a video can hold. The link is in the description below, and it's free. What actually breaks this system is not a crash in the technology. The dot-com collapse did not happen because the internet stopped working. The internet kept working. It kept growing. Amazon survived. Google was founded during the bust. The technology was real. What crashed was the price, because the price had moved so far ahead of the cash flows that the math stopped working even with generous assumptions. Cisco Systems peaked at over 200 times trailing earnings in March 2000. When it fell 89%. It has never recovered to that peak. It is still, 26 years later, below its dot-com high. The top 10 companies in the S&P 500 today trade at an average price-to-earnings ratio of around 50, according to Apollo's chief economist. The top 10 as a group controlled 41% of the index's weight in 2025, but were expected to generate only about 32% of its earnings. The weight has outrun the profits. That 9-point gap between what these companies are worth by market cap and what they contribute to actual earnings is the pressure that has been building since 2023. Passive flows keep pumping money in. Professional fund managers keep riding it. The spending loop between Microsoft and Nvidia stays intact, and the market stays inelastic, less able to absorb a shock, less able to release pressure gradually, more likely to correct the way a rubber band corrects when it finally goes. The trigger doesn't have to be dramatic. It doesn't have to be a scandal or a collapse or a surprise. OpenAI is reportedly targeting $125 billion in revenue by 2029, according to reporting from The Information in March 2026. If that ramp disappoints, if enterprise customers decide in late 2026 that they're spending $100,000 a year on AI tools and getting $40,000 of value, then Microsoft's Azure growth slows. If Azure growth slows, Microsoft trims its next CapEx announcement. If Microsoft trims CapEx, Nvidia's revenue model reprices. If Nvidia's revenue model reprices, the largest single holding in the S&P 500 drops. And when the S&P 500's largest holding drops by 20 or 30 or 40%, the passive mechanisms that powered the rally run in reverse. The same autopilot that bought on the way up sells on the way down. The fund manager who couldn't afford to be underweight on the way up can't afford to be overweight on the way down. The retirement accounts that auto-invested into AI concentration auto-liquidate out of it, and the 500 stock costume